This is CGTN, China Global Television Network.
Hello and welcome to Dialogue. I'm Xu Qinduo. The U.S. Federal Reserve has raised its key interest rate by a substantial 3/4 of a point for the third straight time in their efforts to curb inflation that's persisted near the highest levels since the 1980s. Can the Fed bring a soft landing to tame inflation? What is causing the high prices? And what's the short and the long-term outlook for the U.S. economy? To find out, I'm joined today by Wang Dan, Chief Economist at Hang Seng Bank, Dr. William Li, Chief Economist at the Milken Institute, and later by Professor Iain Begg at London School of Economics and Political Science. Before we get started, let's take a quick look at the Fed's latest move.
U.S. Federal Reserve Chair Jerome Powell warned last month that taming inflation would be painful, and it's proving so.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%.
That benchmark interest rate is now at its highest since before the 2008 global financial crash. And it means that at more than 6%, the average US mortgage rate is now at its highest since that period, a major household expense that keeps rising, along with gasoline. And those gasoline prices are inching up again, if only marginally. The average price of a gallon of gasoline rising just under a cent to $3.68 this Wednesday, and a little higher at this gas station here in Washington, D.C. Nevertheless, that's broken nearly 100 consecutive days of declines after gas prices hit the highest level on record. And those declines had helped the White House argue that the US was getting on top of the highest inflation for 40 years. The headline inflation rate has dipped from its peak of 9.1% in June. But many economists say the latest data suggests price rises have permeated all sectors of the economy, partly due to robust consumer spending fueled by low unemployment. So there's concern Powell may have to effectively force layoffs by raising that main interest rate high enough to make financial conditions tougher for employers. The question is, how high?
At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
One study suggests the Fed will need to push unemployment far higher than its projected 4.1% in order to bring inflation down to its target rate of around 2%. Owen Fairclough, CGTN, Washington.
Well, welcome to the discussion. Wang Dan, I will start with you. Tell us, for those who are not following economic activities closely, why is there so much fear of inflation?
Well, with high inflation, there's also a lot of fear about consumer confidence. We know that high inflation will erode the actual purchasing power for average family. And it will hurt the sentiment for long-term investment for the economy and also everybody's incentive to invest in bond and stock market. So for the U.S. case specifically, people are highly sensitive to gas prices, and there is a political election coming up. Then the politicians are also very concerned on how quickly they can bring down the inflation.
Mm-hmm. William, all consumers are very sensitive to the high prices, for example, gas prices. If the prices is high enough, you will reduce your consumption of the price of the gas, right? Will it work automatically?
In fact, one of the things that
Go ahead, please.
One of the things that we have to keep in mind is that the gas prices are coming down, and a lot of prices that have jumped up because of the supply conditions around the world that pushed up prices because of shortages. Those are getting a little bit better. Gasoline is a good example of that. But the real danger of inflation is how it's socially corrosive. It affects the poor much more than it does the rich. And it's an excise tax. It's a tax that's really a tax on the poor who are not able to have the kind of financial well-being to be able to survive a big constriction on their spending power and something that erodes their wage gains minute by minute. So the social cohesion of the United States and the global population is at risk because high and rising inflation is a very pernicious tax.
Mm-hmm. Well, Wang Dan, what are the factors that will have led to this round of high inflation, either in the U.S., in the U.K., or in European countries? We just received the information. The central bank of the U.K. has just raised its a basis point, like a 50 basis point, to fight inflation. So every central bank seems they have this laser focus on fighting inflation now.
Well, we need to remember that inflation is still ultimately a monetary phenomenon. After COVID, the Western economies, especially the US and the Eurozone, have increased their money supply by a great deal in order to fight the recessionary pressure in the society. And they succeeded in boosting consumer confidence, but then the result is that a prolonged inflation might be here with us for a few more years. And now the central banks around the world, with the exception of China and Japan, have realized how damaging this is. They're trying to bring down inflation. But the complication now is still that with oil prices going on high for such a long time, it is quite difficult to, in fact, bring down effectively. And for the case of the US, the wage inflation has been very high now, with a stronger labor union than before. It is also quite tricky on how politicians can convince that lowering the wage for the average family is a good idea.
Mm-hmm. Well, William, the Fed has raised actually its benchmark rate 5 times this year, including the recent 3 consecutive supersized jump of 75 basis points. It seems like previous rate hikes haven't worked as expected.
Well, the reason why is that the Fed has started so far behind the curve. The Fed had, as of March of last year, still talked about lowering inflation without having to really raise unemployment rate or do anything restrictive on the economy to cut back on spending. And I think the fact that the people have lost faith in whether the Fed can actually carry out their mission, which is to restore price stability, is one reason why a lot of the rate increases have gone by the wayside. People continue to spend like crazy, even though the Fed is telling everybody, we are going to push the economy into a recession if needed in order to bring spending down to where supply is. And that's really the heart of the matter. The past increases take some time to work their way in the economy, but the way that monetary policy works now, because of the transparency, because every central bank around the world is telling everybody, this is what we're going to do. Now, people may believe that and say, wow, if we are going to be laid off, I better stop spending. But people aren't believing that. They say, well, if price is going to go higher tomorrow, I better buy more today before prices go up. And that's exactly the wrong kind of behavior that is causing the Fed to be more and more aggressive.
Mm-hmm. Now we have Professor Iain Begg. Iain, if you look at the inflation situation in the United States, in the UK, and the European countries, are they more or less the same, or the US situation is more serious?
No, I'd say the US situation is less serious for one simple reason, which is that the US is, broadly speaking, energy self-sufficient, whereas in the UK and the major European countries, they are significant importers of energy and thus much more dependent on, or much more affected by the way in which oil and gas prices have been moving. The only good news in this is, I think, that because the prices have risen so much already, it creates a new base, and further inflation should at least be slower than it was in the last year or so. And I agree with what's been said before, that we've seen the central banks, especially in Europe, and especially the European Central Bank, being very slow to react. The Fed, in some senses, has been ahead of the curve relative to its partners, even though it's been behind the curve in relation to inflation.
Okay, slow to act. And also, the Ukraine conflict is expected to last probably for quite a long time to come, given the mobilization and also other activities by the Russian side. So are we expecting energy shortages and food crisis that will contribute to the high prices in the European continent, at least? So it's still, let's say, very hard to tame inflation.
Well, I think we're going to see a hard winter in Europe, especially if the cold Siberian winds start blowing. That's Putin's secret weapon, is the cold cold air coming from Siberia sometimes. But once that winter is over, things will start to change in a more favorable direction because countries like Germany or Italy, which are highly dependent on Russian gas, have been moving very quickly to find alternative sources of gas, but also to accelerate their shift towards renewable energies and other means of avoiding gas. So it's a short-term problem for Europe rather than one which I think will last 3-4 years.
Wang Dan, as we reported earlier at the beginning of the show, there's a slight uptake of the gas prices, less than 1 cent, after basically 100 days of consecutive decline. What has caused that? And also, if you look at the home sales, the new home sales, it has been falling, and probably like a ticket, airline ticket, and used cars, more or less, also cheaper. But overall spending is very strong in the U.S. market still. So it's kind of like a mixed picture. Can we see that?
Yes, it's very much a mixed picture. And even with the economic slowdown in the US, it's still on the high base that the economy has been running on this overheated situation for quite a number of months now. And when we look at the consumer confidence in the US, it's still at a historical high. And part of that reason is exactly the generous subsidy from the federal government, and also a very expansionary monetary policy since COVID has started. So now the US economy is in fact under pressure to enter this recession. But the slowdown is mainly coming from the slowing housing market. And when we look at people's purchase of new homes, the sales in the recent 2 months have slowed significantly from the first half of the year. And in the coming month, we probably will see similar trends because the mortgage rate had been nearly tripled in the past 6 months, and there is no sign of decelerating.
William, so it seems like the only tool we have right now is the Fed to raise interest rate. What about the government or the budgetary or the fiscal policies? Is there anything they can do, or they can still continue to, I don't know, like approve bills of spending on this and that to say develop a manufacturing sector or say new automobile, new vehicles, etc.?
It's always good to hear analysts from abroad tell the United States one major reason why you have the high inflation you have is because people are just spending way too much, including the government. And the government has enabled people to spend more because they've given them so much in the way of subsidies, tax rebates, and the excessive amount of government spending that has gone on. If I were to say that, they would say, well, he must clearly be a Republican. But for Wang Dan to say that is I think, adds a lot of credibility to, I think, everyone's generally agreed upon analysis, which is to say we have the inflation we have because spending power exceeds the available supply. And yes, people are asking for higher and higher wages because they don't believe the Fed is going to be able to bring inflation back down to 2% in a reasonable amount of time. So they said we need higher wages just to be able to keep up with the high and rising inflation. So the fact that government spending has caused a lot of this excess spending power to exist. The likelihood of the government cutting back on that in an election year, especially in the midterm elections when the Democrats stand to lose so many positions, is a wish and a prayer.
Well, for the government, probably more challenging for them to take any initiatives on that respect. So Iain, of course, if you allow the inflation to continue, for example, in the U.S. at 8.3%, almost the highest in 4 decades over there, that will create problems, as William earlier said, in particular to those consumers, let's say less well-off consumers. But then, if you increase the rate so rapidly and so aggressively, there are also consequences, right? Like job cuts, probably unemployment rate getting higher.
Yes, the standard way of dealing with inflation is to slow down the economy to prevent it overheating. But what we're seeing to some extent in the US and to a greater extent in European countries is a switch with loose monetary policy being slowly tightened. And I noticed, by the way, that while we're on air, the Bank of England has just increased its rate by 50 basis points. and a switch towards fiscal policy, a loosening of fiscal policy in many areas to try to cushion the effects of the high inflation. Now, this is a delicate balancing act, because if you use too much fiscal policy, you risk adding to inflationary pressures for the reasons that William has just been explaining, which is that it creates additional demand at a time when supply is constrained. So both in the US and in Europe, they're walking a tightrope between trying to deal with inflation without triggering too much of a downturn, but at the same time doing enough to prevent inflation taking off again. And it's very, very hard to know whether the judgments that are being made in monetary policy are yet strong enough to do this. Let's be blunt about this. Real interest rates on both sides of the Atlantic are still deeply negative. With inflation at 10% and an interest rate at 2.25% as in the UK, that's a real interest rate of -8%.
So there's still a long way to go, probably. And Wang Dan, of course, Fed Chairman Jerome Powell said that at the news conference, no one knows if this process will lead to recession, and that chances of a soft landing are diminished. As Iain mentioned, it's a delicate balance. On one hand, you want to reduce this interest rate, increase the interest rate and reduce the inflation pressure. But if you go too far and then you hurt the economy to that point of having a recession, which you don't, right?
Well, the problem is not if the US is going to have a recession, is how long the recession can last. Because technically, if you have 2 consecutive quarters of GDP slowdown, you are entering the recession. And there is no sign of slowdown of this rate hike for the Federal Reserve anytime soon. And in 2020, we have seen that the Federal Reserve has changed its inflation target to about 2% during a certain period of time. And we know that eventually inflation has to fall below 2% in order to have an average of 2%. I would be very surprised that within the next 3 years, that the Federal Reserve can actually achieve that goal, which means at least we will not see a rate deduction anytime soon. And what that means for the economy is the housing market will still probably under pressure for a very long time, and the stock market will also be quite depressed. And that will certainly hurt the long-term sentiment for the general public, because that would probably change some of the long-term behavior. People will be reluctant to spend, the companies will be reluctant to make long-term investment, and even the average family will make new decisions about their family planning. People might choose to have fewer babies just because they have this pessimistic outlook for the long-term growth of the economy.
Mm-hmm. So William, what's the risk of overdoing, the say rate increases here? We know like there could be a recession. How dangerous is that?
Yeah, Chairman Powell has been invoking the name of Paul Volcker because Paul Volcker was the one chairman who was able to successfully get rid of incredibly high rates of inflation, 20% easily, back in the 1980s. And the reason why the name of Paul Volcker is being invoked is because at the time of the 70s and 80s, no one ever believed that inflation would ever come down to a 2% level. And because of the disbelief, the lack of credibility in the Fed had to be much, much more severe. Today, we are in a better position in the sense that financial markets, the way they're pricing inflation, break-evens are about 2.5% for 5 years. The longer-term break-evens are even lower than that. So the financial markets have some confidence that we will get back to 2% or near 2% in the 5 to 10-year horizon. The big question is, what about today? What about the next 6 months and 2 years from now? There's no credibility that the Fed will be able to do anything in that time. And so the Fed is saying we're going to be much, much more severe than we have to be because you don't believe us. If you actually believed us, you would be spending less, saving more, and inflation would actually automatically come down. So the severity of the recession really is very adaptive. Economics is not physics. We cannot just push a couple of buttons here and expect something to happen later on in a predictable way. It depends on how people perceive the policy environment and the credibility of the Fed. And right now, the credibility of the Fed is still very low, which is why we need to invoke Volcker-esque type policies to get people back on track again.
Mm-hmm. So Iain, it seems like the work has a lot to do with expectation, sentiment, psychological factor here.
Yeah, so central banking is a very curious art form because it's about not just setting interest rates, but managing expectations, as William has signaled. And managing expectations is a combination of what you do and what you say. And what you say on some occasions has been more important than what they do in terms of, say, changing interest rates or altering quantitative easing. Just a small aside to what William was saying about Volcker in the 1980s. What we saw in the 1980s was a combination of Volcker tough monetary policy and Reagan very loose fiscal policy. That was succeeded in the 1990s with Clinton having relatively tight fiscal policy and Greenspan having relatively loose monetary policy. So we see these fluctuations going on all the time. But can I return to a point I think I made on dialogue previously, which is that one of the reasons for all this is that the monopoly power of energy producers, particularly the Russians in relation to Europe, or even Saudi Arabia in relation to the oil, and other OPEC countries in relation to the oil market, has resulted in a shift in the terms of trade away from the consuming countries towards the producing countries for energy. And it's only when that unwinds, which it will do, because it's happened before, they cannot continue to extort using their monopoly power for all that long. When that unwinds, it will have a relatively favorable effect in restoring real incomes in the countries which consume energy and in bringing down inflation rates. The only question is exactly how long is that going to take? And I don't think any of us can reliably predict how long that transition will take.
Mm-hmm. But Iain, in the case of the U.S. is energy independent. Basically, they are not relying on the, say, import of oil and gas from Saudi Arabia or Russia, right?
Not to the same extent as Europe or indeed China. But the knock-on effect is raising prices globally. And that raising of prices means that even US energy producers will be winning the windfall profits, whereas the consumers are the ones who are suffering from the higher prices. So it's that there can be a double terms of trade effect between countries, but also between sectors of the economy.
Mm-hmm. Bit complicated over there, international market. Powell insists the central bank will not be swayed by political pressure. William, basically his idea is like we want to avoid what happened in the 1970s, the mistake in the 1970s. So tell us, obviously he's very determined. He's saying that I'm not afraid of this political pressure, possibly from the Democrats or the Biden government. Or what is the mistake of the 1970s?
The big mistake of the 1970s was that Paul Volcker actually had two stages of monetary policy. He tightened, then he eased up before inflation was brought back down to a reasonable level of 2%. And that was the big mistake. It's known as the stop-go type of policies. And that causes the Fed to lose even more credibility. And the second round of tightening becomes much, much more severe. And that's needed to bring inflation finally back down into control. That's the one thing that Chair Powell cannot allow to happen, because that would induce a wage price spiral. When you fail to bring inflation back down, the first thing people do when they demand more wages is to anticipate your failure yet again and ask for even higher wages. That's the corrosive behavior of the 70s that Chair Powell is determined not to repeat.
Mm-hmm. Wang Dan, you mentioned about the sentiment in the market. Obviously, we have seen that the volatility, before and after the decision by the Fed to increase 75 basis points, and then the statement over there. So long term, seems like the market is kind of confused. They are expecting like a pivot, a change of direction. But obviously, do you think they are now getting the message? The Fed is determined to continue to increase the rate in the rest of the time of this year and the beginning of next year at least.
Well, it just seems that the Federal Reserve's determination has become more obvious over time because the inflationary pressure has been accumulating. It has become not just an economic problem, but a political problem. And many people say that the Federal Reserve will not cave to political pressures, but wherever the truth may lie, the fact is they have been keeping the interest rate artificially low for a long time in order to keep the growth rate at a reasonable level. And at this point, I just don't think the Federal Reserve has much maneuver room to revert their current stance. But they should also be aware, and I'm sure they are aware, that an aggressive tapering will not only have a negative effect on the US, but also will have a huge spillover effect on the emerging markets. So they might keep their rate hikes for a while, but I'd be surprised that they will keep this kind of 50%, 50 BP and 75 BP till the second quarter of next year. It will be very devastating for smaller economies.
Mm-hmm. Tell us more about that, Wang Dan. Emerging economies, developing countries. You do hear there are a lot of concerns with the U.S. Decision to continue to increase the rate. Obviously, as you said, spillover effects. Probably there are, I don't know, like cost of borrowing could be more expensive, financing debt, importing goods from other countries, more challenging.
Well, the reversal of the QE by the Federal Reserve is very clear at this point to any emerging market. And we have already seen some level of sell-off of their bonds and very high depreciation pressure for their currencies. And over time, the capital flight or a rather aggressive capital outflow from those economies will become more obvious, because I don't think we have seen the full impact yet at this point. By mid-year next year, I wouldn't be too surprised if there are some kind of debt crisis for certain economies, including the fragile economy like Turkey or Argentina, or some of the mid-sized economy in Asia. So the Federal Reserve can see that their action will cause an aggregate impact that's higher than 2013. So I think they will tread very carefully.
Mm-hmm. William, as we said, we're seeing not only the central bank in the US, in the UK, European central banks, Canada, Australia, they are all basically increasing the rate to fight the inflation. Are those actions well coordinated?
Well, it's coordinated in the sense that they are aware of each other's needs domestically. Every country that has raised rates aggressively has said, we're doing it because we need to bring inflation back down to our target level of 2% or below 2%. So in that sense, it's coordinated. But let's face it, the United States is a global central bank and influences global economies and global markets. No question about it. And our policy has terrible consequences in terms of a stronger dollar for other countries. But ultimately, the United States central bank is the Federal Reserve. The Federal Reserve is the central bank of the United States, not of the rest of the world. And I think that's the first message that everyone has to understand. The objectives and policies taken by the Fed will be for the needs of the United States first. And the consequences, the terrible consequences for the rest of the world will have to be dealt with by their own economies and through aid from international agencies like the IMF and World Bank.
Mm-hmm. So Iain, basically the message is like, as we former U.S. official said, our currency, but your problem.
Well, quite clearly, because it's been a very clear message to the rest of the world for a long time. When the Fed initially tried some tapering after the financial crisis, it was based on U.S. principles. William was exactly right on that. And there's a combination of things that are going to happen to other countries, which is not just the debt, but the risk that the devaluation of their currencies will lead to still higher inflation, partly exacerbated by the fact that so many commodities are priced in dollars, which is a bit of an illusion because the price in dollars should reflect global supply and demand. But nevertheless, it can have an unusual effect on individual countries if they notice that the oil price has not just gone up, but they have to provide more of their national currency to buy the dollars to pay for the oil. So the two things,
right? Well, we have to
unfortunately tend to reinforce each other.
Well, that's the end of today's show. Many thanks to our guests. You can also find us on the CGTN app on YouTube. I'm Xu Qinduo. Thanks for being with us. See you next time.